So just a little story, like I actually already completed the course and now I realized that this file was missing for some reason. Maybe I forgot to copy and paste. So in any case, I'm just re-recording the this topic. So let's get into it. So this topic is obviously adjusted trial balance. So I want to show you how you can prepare the adjusted trial balance after you have prepared the adjusting entries. So as we know, the accounting cycle goes like this. You make the journal entries, from the journal entries the T account, from the T account the unadjusted trial balance, which is this one by the way, and from unadjusted trial balance we prepare the adjusting entry, and after the adjusting entries now we can prepare the adjusted trial balance. So let me show you how to make it. Very easy to do so. It's just like you have to understand like small concepts here. Adjusted trial balance. So let's make our format. Okay, so just to let you know, now in these adjusting entries are like, there's no transaction to them. I assume these are the adjusting entries. Okay, you have to assume these are adjusting entries. So I can show you how you can have a unadjusted trial balance, and then you prepare any adjusting entries that the question requires, and then you get to the adjusted trial balance. So these are, I just assume these adjusting entries. Okay, obviously it will be according to whatever question you have. Okay, so in this case, first of all, we will look at the first account. Let me take this down and make it a bit larger. There we go. Okay. So to go from unadjusted to the adjusted, it's pretty simple. You look at the account. First one is cash, 19,600, and you have to see if it's affected in the adjusting entry. Is cash affected in the adjusting entry? No. That means the balance is already correct. It's already an adjusted balance because there's no adjustment for it in the adjusting entries. Prepaid insurance, we have 4,500, but if you look at the adjusting entry, we are decreasing it by 2,000. How do I know it's a decrease? Because we talked about prepaid expense is an asset account, and if it's credit, it means it's decreasing. So if I already have 4,500 and then I decrease it by 2,000, the remaining balance in the prepaid insurance account would be 2,500, and that's what we have to do. We have to look at each account and see if it's affected, see each account, see if it's affected. So supplies, is supplies affected in the adjusting entries? No, because there's no mention of supplies. We just copy paste, right? Nothing to change. Same with land, building. So I hope you're noticing, like, we are looking at each one account and then we are checking if it's affected. If it's not affected, we are literally writing the same balance. If it is affected, then we are making the adjustment for the effect and then writing the final balance there. Okay, after building, we have equipment, which is 16,000. There we go. Accounts payable, which is 4,500. Since again in the adjusting entries, these are not affected. Unearned rent revenue. Okay, unearned. Let me write again. Unearned rent revenue. So let's see. Is rent revenue affected? Debit. It's a liability. So debit means it's decreasing. So if originally I had 4,600 and then I decreased it by 1,000, that means remaining balance will be 3,600. So then we have mortgage payable. Let's do that one. Mortgage payable, 60,000. If you haven't seen some of these accounts, like ignore it, right? Like every liability is like same, right? If I say not every liability is same, all of these liabilities are same. If I say rent payable, salaries payable, utilities payable, mortgage payable, like all of the expense payable are obviously the same thing. So in this case, mortgage payable, it can also be loan payable. All of these are liabilities that are treated the same way. Okay, then we have common stock, which amounts to 91,000. Retained earnings, which amount to 9,000. Again, why am I not adjusting? Because these accounts are not adjusted here. So I don't need to worry about changing their balance. They are already adjusted. Dividends, again mention the same number. Rent revenue, this one is affected. If you notice, rent revenue is being credited, that means revenue is going up. So if we already have 76,200 and it's again going up by 1,000, that means the new balance will be, there you go. After this one, rent revenue, we have salaries and wages expense. Salaries and wages expense, which amounts to, in this case, 44,800. And then we have utilities expense. So utilities expense, which amounts to 9,200. And then we have maintenance and repairs expense. Repairs expense, which is 3,600. Now I hope you realize that for utilities expense, we do have a effect here. So me writing the same number as this is actually a mistake. So what do I have to do? I have to take the unadjusted balance, which is 9,200, and adjust it for what happened here. It got debited. We know expense, when it debits, it means it's increasing. So we'll do plus 900. Now we have the correct adjusted balance for the utilities expense. Okay. Now a couple of things for you to know. Now we've done the most of the part, right? But this last step remaining that I will always tell you to make this a habit for you yourself, to like make never make mistakes in this topic. So what you want to do is, once you have done all of the accounts there, now you have to check, okay, which adjusting entry accounts are not present here, means we didn't have any balance in those accounts. Insurance expense, do we have insurance expense? No. So that means we can assume insurance expense probably has a 0 or definitely has a 0 balance. That's why it's not shown here, right? So if it had insurance expense had a 0 balance and then I debited it by 2,000, now I have to mention it because it's worth some amount, 2,000 debt. So I hope that's clear. When account is not mentioned, that means that account is 0. So when you are adjusting it for whatever the effect in the adjusting entry it had, just record it with that amount. And prepaid, we already did that. We already have that account, right? Where was the prepaid we recorded? There we go. Okay. Then unearned rent revenue, we also already have that. Rent revenue, we also have that. Utilities expense, we also have that there. Utilities payable, we don't have. So utilities payable, we have to mention ourselves. Again, the logic is, if it was not present, that means we can assume it was 0, and since it's being credited and it's a liability, it will increase on the credit side. So we have to increase it by 900, so now it has a 900 balance. Now this is where the moment of truth comes. Now you need to do the total of the debit side and credit side. If you solve it correctly, both will be the same number. Let's see. Yes, there you go. And that's how you solve the adjusted trial balance. Done. So I hope you understood how do we go from the unadjusted trial balance to the adjusted trial balance, and you saw the importance of adjusting entries to help you get there.